Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1428A, and today's date is November 17th, 2017, and the title of the episode is The Central Banks Are Now Preparing for the Financial Crisis. Let's get into the economic collapse financial news. Now, about 2 months ago, Jamie Dimon was out there, and he was talking about Bitcoin, and he lashed out at it. He said that Bitcoin, is a money laundering tool, and it's a complete fraud, and it's just like the tulip bulbs. It's just like every other bubble, and he was going on and on and on about it. And what's very interesting is we found out that one of his offices in JP Morgan is actually trading Bitcoin. We also find out that JP Morgan was busted for money laundering. And when we see what is happening here, we see that he was out there telling everyone that Bitcoin was a money laundering tool while he was money laundering. And we know that JP Morgan, they're doing a lot of things under the table. We know that they've been manipulating the silver market. We know they're behind many of these things that we see happening today. And what's very interesting is that the Swiss subsidiary of JP Morgan, they were sanctioned by the Swiss regulator, FINMA, over money laundering and seriously violating supervision laws. So once again, these individuals who call out and say things about Bitcoin or anything else, it always seems it's really about them and what they're doing. Remember, everything the governments, the central banks, these financial institutions, when they tell you something, it's always the opposite. Actually, it always goes back to what they are really doing, and they don't want to be found out about it. Now, we understand that the blockchain technology, it's new, it's up and coming, just like the internet. The central bankers, the banking community, well, they want to control it. This is going to be very difficult to do, but they're going to try to do it because if they can't control it, there's no need for the central bank. There's no need for the banking system. The system can run independent of all of this. It's running independent of all of it right now. And as more and more companies, retailers, start using the blockchain technology and start paying people in cryptocurrencies and more retailers accept cryptocurrencies, we are going to bypass the banking system. We're going to bypass the central banking system because right now the central banking system, they issue the Federal Reserve note. This is what we use to purchase goods. Well, the crypto coins, they don't issue these. They have nothing to do with them. And if these are used for transactions, like you're paid in it, and then you can use it to purchase goods, and you never have to go into the Federal Reserve note, we bypass them completely. This is what they're most afraid of. And this is why they're trying to take control. Because they know that they need to control all of it. Not just what they're doing. They can't let any other currency pop up where they don't have control. Here in the United States, we understand that the brick and mortar stores, they are failing and failing hard. We see right now that there's a lot of retailers that have declared bankruptcy, and a lot more retailers are closing down. And of course, the corporate media, they're out there saying it's the Amazon effect, and they're telling us that e-commerce, they're the e-commerce online shops, they're taking away from the brick and mortar stores. But we need to understand something very important, that only about 10%, actually 9.1%, is e-commerce right now. And a year ago it was at 8.2%. And yes, it's growing, and it will continue to grow. But we're not at that point where e-commerce has taken over the brick and mortar stores. Think about this for a second. There are still several large brick and mortar sectors that are still considered online proof or e-commerce resistant, whatever you want to call it. And if you look at it, you can see this is the certain areas like new and used vehicle dealers, auto parts retailers, that's 20% of total retail. Grocery and beverage stores, that's 12.6% of total retail. Now, we know that Amazon, Costco, Google, online grocers, they are trying to get into this market, but it's very, very tiny right now. And we can see that this really isn't having an effect on the online shopping. So what we're really looking at is, electronics, clothing, and other doodads that are sold over the internet. Gasoline stations, they make up 8% of total retail sales. Restaurants and bars, they make up 12% of total retail sales. Remember, new and used vehicle dealers and auto parts, they make up 21%. And all this might change in the future, but right now, as we can see, they account for 54% of total retail sales. So right now, e-commerce is not really the main area that's hurting brick and mortar. Now, think about this for a second. Despite 16 years of inflation, population growth since then, department store sales have plunged by 35%. And the population is growing, the unemployment has come down to 4.1%, and retail stores, they're hurting, they're closing, and we don't see that 1-to-1 ratio going to online. So it's really not happening. Now, Wall Street, they are realizing there is a problem in the brick and mortar retail industry. They're calling it a brick and mortar meltdown. And what they have done, and this is very interesting, they created an ETF, and it focuses on the retailers. The ticker is named EMTY. And what this ETF does, well, it is specifically designed to benefit from the decline of bricks and mortar retailers. Now, as we can see, they have an index of department stores, supermarkets, retailers of apparel, consumer electronics, home improvements, and they're watching these specific stores: Rite Aid, JCPenney, Office Depot, Sears, Smart and Final stores, Express, GNC Holding, Barnes & Noble, Chico's, and many more. Now, if we look, Rite Aid is down 82%, JCPenney down 62%, Office Depot down 47%, Sears down 67%, and it goes on and on and on. So they know what's going on here. They know it's going to be a disaster. And it's getting worse. I mean, if we look in Manhattan right now, we can see that retailers are being priced out of business because rents right now, they are skyrocketing. And this is because of all the bubbles that were created. And if you look at the map of Manhattan, Midtown and Upper and Lower Manhattan, you can see that there are empty retail storefronts everywhere. And it's growing and it's getting worse and worse and worse. And it's going to get a lot worse after this holiday season. We see that the Texas Bullion Depository took a step closer becoming operational earlier this month when officials announced the location of their new facility. Remember, the state of Texas, they created the State Bullion Depository. This is a shift away from the federal government to the state, and it provides a blueprint that could ultimately end the Federal Reserve monopoly on money. Now, Governor Greg Abbott signed legislation creating the State Gold, Bullion, and Precious Metal Depository in June of 2015. The facility will not only provide a secure place for individuals, businesses, cities, counties, government agencies, and the rest to store their gold and other precious metals, the law also creates a mechanism to facilitate the everyday use of gold and silver in business transaction. In short, a person will be able to deposit gold or silver in the depository and pay other people through electronic means or checks. And again, they're getting away from the Federal Reserve note. So what we see here is that we have the cryptocurrency market, where that is completely separate and apart from the Federal Reserve. We see states now are taking on gold repositories and dealing electronically, trading gold and other precious metals, getting away from the Federal Reserve note. And everyone is protecting themselves because they understand the central banks, they're going to be in trouble. The dollar is going to be in trouble. And we know that everything that is in this country that has to do with the financial institutions, has to do with Wall Street, it's all manipulation. We know because we see that the banks were colluding through text messages back and forth to fix the price of silver and gold. We know the central bank has been purchasing stocks. They have a trading desk in the basement of the Federal Reserve. We see that some of Wall Street's largest primary dealers in the U.S. Treasury market, well, they illegally shared client orders via online chat rooms to game the Treasury auctions. Now, Wall Street banks secretly shared client information in online chat rooms in order to rig auctions for the $14 trillion U.S. Treasury market. Now, these accusations are out there. They're saying that, yes, this is absolutely true. They have evidence of this. And the banks that are implicated in this are Goldman Sachs, Morgan Stanley, the Royal Bank of Scotland. We see UBS is there. And I'm sure there's going to be a lot of other banks that are going to be included in this. And we see right now that we're seeing this all over the place. And more of this is coming out. When we look at what is going on here, we can see that there's been manipulation all this time. We've been following a lot of this. We've been tracking it, showing how they manipulate all these different numbers. There was speculation that they were manipulating the gold, the precious metals market. They were manipulating the statistical numbers. The banks, they are part of the central banking system. And we see from what has been going on for all this time, they have been doing this for a very long time because their system is failing. Now, what's very interesting is that the U.S. Fed and other major central banks are seeking to implement new monetary policies. Now, these are untested. Why are they doing this? Because these new monetary policies, they're going to address future economic problems. And they want to deal with them more efficiently. Because when they look at their current policies, they all have but been exhausted, and there's nothing they can do at this point. So the U.S. Central Bank is going to change its approach to monetary policy. San Francisco Fed President John Williams called on global monetary authorities to rethink their policy rules. Now, previously, when a recession hit, central banks' first response would be cutting interest rates in order to support domestic lending and consumption. However, neither the ECB nor the Bank of Japan are able to provide such an accommodation if there is a new recession or another economic crisis. This means these regulators would increase asset purchases in the case of an economic crisis, resulting in devaluations of the respective currencies. This would result in an even greater trade deficit for the U.S. Williams outlined the possible tools global central banks could use to provide a safeguard against future recessions. These do include going deeper into, yes, negative rates and bond buying and more stimulus. And once again, by doing this, this could trigger a deeper recession. It could trigger a global shift towards a planned economy by the central bankers. Isn't this what they always wanted? Yes, it is. So what are they doing right now? They're reworking their approach to what is going on because they've completely planned and controlled the economy for so long that they need to change on how they approach what is about to come. And what is about to come is a new economic crisis. So they're going to rewrite their policies. They're going to have governments vote on it. And they're going to be allowed to do all these things when a recession hits. Because they know a recession is on its way. They know that it's very close. And they want to get ahead of it. And they want to control all of it. Not just a little bit, because we're going to see a lot more information come out where they're going to be controlling everything now. That is their major plan. Now, should we be worried about another recession? Yes. Here are 10 reasons to worry. On a total return basis, the S&P 500 has been up 12 months in a row. The S&P 500 has only pulled back from peak to trough 2.8% over the past year. Junk bonds have weakened relative to equities over the past few weeks, and historically, this has been a warning for equities. The yield curve is the flattest it has been since 2007. The S&P 500 hasn't closed lower by 0.5% or more for 50 consecutive trading days, the longest streak since 1968. The S&P 500 isn't finished red 3 days in a row for more than 3 months, the longest streak in 7 years. The S&P 500 has corrected 3% from its all-time high for over a year, the longest streak ever. The average daily change for the S&P 500 in 2017 is only 0.30%, the second smallest range on record behind 1964. Transports have been very weak recently, a historical indicator of weakness under the surface. November, historically one of the strongest months going back to 1950, but over the past 10 years, the second half of the month has been weak. And we can go on and on about other things to worry about. GDP, the fake unemployment, retail imploding, housing imploding, the entire system imploding on itself very, very quickly. And as we can see, the IMF has been reporting that there's a global crisis headed our way. It was buried in their paper. We see the Federal Reserve and the central banks, they are rewriting their plans to prepare for this next crisis. And they know, because the business has been out there telling everyone, that this debt is unsustainable. They know what's coming. We know what's coming. This is why you need to get prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.